Hi, everyone. Welcome to the Seattle Angel Conference Workshop Series. We're working today with a number of people who are helping companies make progress, who have been actively investing or have been invested in. And I'd like to go around the room and introduce our speakers a little bit. And so let's start with Benton. Can you introduce yourself, please?
Hey, John, good to see you and good to be back in Seattle, one of my favorite places outside of San Diego.
Thank
Um,
you.
I am Benton Moore, and been an angel investor for about close to a decade, I guess now. I've done over 200 deals, seed and Series A usually. I am the director of the Brink, which is the SBDC at University of San Diego. I have a lot of other hats that I wear, but I am very much in the startup space. And most importantly, before becoming an investor, I was a founder. I sold my company to private equity and did not want to retire, but wanted to fund the next generation of innovators. And that's how I came to meet Silvia Ma and Bobby Edelman and some other talented people, including you, John, when you set up the very first San Diego Angel Conference, SDAC, the southern sister of SAC. And we are now on, what is it? Coming up on SDAC 9. So we do an annual. It's not as often as SAC. But my focus is very much on sustainability and clean energy, electric vehicles, battery storage, data centers, all kinds of fun deep tech that I think is going to change the next generation of the planet. But I also invest in life sciences and fintech and just about every other sort of technology, and I do that in groups, including San Diego Angel Conference, including New Fund Ventures, the Castor Ventures out of Boston, and then Techstars in Orange County as well. So I'm a very active investor. I'm not always writing checks, but I'm always hearing pitches. And I love working with technical founders, especially engineers who are not necessarily have not necessarily spent their life doing marketing and presenting, but have brilliant technology. And working with early stage companies is a blast. So it's hard out there if you're not an AI company to raise funds, but hopefully we can give you some tricks of the trade today. But yeah, that's me. Wouldn't be here without Silvia, wouldn't be here without John, wouldn't be here without Bobby. So really happy to have this panel with you all.
Cool. Thank you. Sylvia, how about an introduction for you?
Yeah, wonderful. Hi, everyone. Welcome. Thank you, John, for having us on this panel. So, Dr. Silvia Ma, and I'm actually the fund manager of Fund One of San Diego Angel Conference. Took that kind of on as Misty Rusk, who now is in Seattle, and John Seacrest. We're trying to see, like, is San Diego a great place? It is a great place. So took on that first fund management opportunity, and from then on was part of the co-fund management team all the way to Fund 7. Benton was fund manager number 2. And it was just amazing to be able to be alongside him, seeing how does he formulate from being an angel investor to being a fund manager. So I'm speaking to the angels in the room, is that we can answer questions like that. I have about 150 plus companies in my portfolio. About 80% of them are individual investments into companies. I love deep tech. I'm a PhD in biochemistry, molecular biology, and taught engineering for 7 years. So I love tech and I love investing in it. I primarily invest in female-led businesses. Because there's obviously an opportunity there. And then also, I've invested in 15 emerging fund managers. So I've been an LP on multiple funds: Mindshift Capital, Rising Tide Fund, Portfolio, all the, like, the women-led, gender lens investing funds. I've tried to be an LP on it. I've also done SPVs so that I could be an LP in some of these funds. So I've done kind of a lot of different things. And then my my day job is that I'm the director of innovation at Biola University, the Bible Institute of LA, a small seminary college in Orange County. And I'm a professor of innovation and entrepreneurship there. So I love the undergrad space. I love teaching. And that's my day job. And then my other day job is being an advisor at the Brink SBDC, the Small Business Development Center here in San Diego and Imperial County. And we really are advisors and mentors and coaches and all the things to small businesses, tech startups, because we are a tech center here at the Brink. Benton is my boss. I always call him the boss man. And it's just a huge blessing to be able to be part of an advisory group with Bobby and others. So if you are an entrepreneur, find that ecosystem that has that type of thing, because we are here to serve and to support entrepreneurs in the launch and scale of their businesses. So that is the Brink SBDC. Proud to be a part of it. So that's me.
Cool. Thank you. Bobby, how about you?
Okay, John, thank you for having me. I won't repeat everything they all said, but basically, I have roughly 200 companies I've invested in. About 60 or 70% of them today are direct. I'm eclectic in nature with a heavy emphasis on fintech, equity crowdfunding platforms I've invested in and on that have secondary marketplaces. But I have invested in esports, med tech, consumer products, foods. They'll light on the consumer product side, lots of biotech, genomics. I've been part of the San Diego Angel Conference, not the first year, but the second year. And so I've been actually what I would consider a full-time professional investor now for coming up on 7 years. My background is in technology, semiconductors, computer products. I was part of the management team that took a $60 million company to a Fortune 500 and then sold it to a larger Fortune 500. I was the early internet. I created a thing called Net Seminar, built the first streaming studio in 1995 in Los Angeles, and have a number of internet platforms, other products. I've had small businesses where I use my 401k and my credit cards to run them. So I know what that feels like. I've had a couple of failures, partners, and also just bad decisions I've made along the way. I've had people embezzle from me. I've built apartment buildings in Los Angeles. I've raised capital in what I call the 21 ways to raise capital. And I try to really go where the founders have to be, meaning every day you've got to figure out how to have enough capital, or whether it's debt or equity, to run your business and to operate it. And I try to be creative because not everyone is going to be a unicorn. Most aren't. Most aren't going to go public, but they're going to run great businesses and provide economic value to their family, their community. And that's what I'm about. And so I've been involved with programs at San Diego State University. I'm involved in some philanthropy programs at UCSD. And that's it. So I'm open, today to any questions, comments. I like to say I live where the rubber meets the road, where reality is for most founders, and get into that deep discussion, because even though you have great help generally, strategically, you can create great pitches today. You can put the words on paper, but it's really the tactical execution very often of that makes a difference. So I'll stop at that.
Cool. Thank you. David, you want to do a quick introduction?
Sure, David Busby. I've taken 2 companies through SAC on the founder side, which is how I got involved in this whole group. And that was like 1,000 years ago. I joined SAC on 25 as an investor, and I've been slowly refining my skills. Now at SAC 30, I'm going to do the deal lead and figure out what it looks like making the SPV and negotiating the deal. And then I think that'll be what it looks like when I graduate from something that is affectionately referred to as John's angel investing kindergarten. And so I'm excited to be here and see if I feel like I'm going to learn more than I'm going to be helpful. And so I'm excited for that. And then also, Silvia, You mentioned some stuff about SPV, so I would like to connect with you after this and talk about
Yeah.
building SPV, because that is a problem that is sitting right in front of me at the moment. Thank you.
Yep.
So we run the Seattle Angel Conference as a training program for the early angels who have the wealth but have never thought about being in the asset class before and helping them step into the asset class as their first investment. And we do it with the intention that they come through multiple times. And the theory is they come through once as a participant, they come through a second time as a due diligence lead, they come through the third time as an assistant fund manager, they come through the fourth time as a fund manager, and by then they've decided whether they like this enough to be a full-time investor, to start a fund, to do other things, and we're cultivating that lead investor role. On the other hand, we're seeing 60 to 70 companies. I know that in San Diego you have a different cap, but we see 60 to 70 companies each cycle. But this is sort of intended to simulate what it looks like to be in the ecosystem doing things. So we go out to see companies and find interesting companies, and we go to startup events and we mingle with people. And we sort of have this notion that we look at 1,000 companies where 900 of them are like, don't pass our filters beyond hello. And then of the 100 that are left, we sort of scratch at them a little bit, but then they're not really in the right place. And then we've got 10, and of those 10, we sort of dig deeply, and then we invest in one, right? That's sort of the pathway here that as we bounce around the ecosystem. And so as a founder, how do I get found by you? And what kinds of things are the things that leave people in the 900 or bring them into the 100 or bring them into the 10 that we scratch at early? And then what are the things that are compelling enough to be investable, right? So why don't we start at the far edge of the sales funnel here, essentially. And you're walking, you go to a startup party for Seattle Tech Week or San Diego Tech Week or whatever, and there's 15,000 people in the room, many of whom think that they're founders. What gets them to the next meeting? Yeah. Benton, you want to start with that?
Yeah, we're all in Angel Kindergarten, which is a great sandbox to play in, and it's a contact sport, angel investing. So you have to do it as a team to do it right. And I like the concept of your idea that some of them think they're founders, right? And um, I take issue with a lot of so-called entrepreneurs who think they're founders and really they're just looking for something easier than their current employment. And that's one of the first weed outs for me is, are you committed? And like the characteristic that always shines through when I'm looking at early stage companies that are going to be successful is tenacity. The founder, and it has to be a real founder, has to be so committed that they want to get up on Saturday and work on this problem. It's not because, oh, they hate their job at Qualcomm or the Navy or Boeing. They actually see a problem that they can't stop thinking about solving. And that is a personality flaw or defect or driver, depending on how you look at it. And that generally comes across in the first 15 seconds. If you've had enough of these conversations, right, John? Like if you've had enough coffee meetings, you can suss this out in the first 15 seconds. And that's the non-financial metric that is getting you from that 900 into the top 100. Then you can start picking it apart. That's the very first thing.
There's a certain amount of um, inherent bias built into that 15 seconds that you just talked about, right? Who you walk up to in the room, how you start the conversation. And at least for me, I can't quite get there in 15 seconds. I really have to do, like 90 seconds. But it is relatively quick that you find somebody who's actually committed themselves to a task, right?
As an investor, I think we kind of gear ourselves for 60 to 90 seconds. But the reality is, when we're training up entrepreneurs, we tell them you only have 15 or 30 seconds because inevitably
You
our
give them
attention span is
15 and they
shorter.
take,
There's
yeah, yeah.
someone's bringing you a cocktail, someone's spilling a coffee, who knows? But yeah, that's, if things go well in the first 30 seconds, you want to get to the next 60.
Is
Sylvia
there any,
has some insight here, I'm sure.
yeah, Sylvia, you have any insights on that first step of, I run into a person and it goes, we try to simulate that with the 1 minute pitches. And we'll talk a little bit more about the 1 minute pitches here in a second. But what kinds of things get you from the 1,000 down to the 100?
Yeah, I have I'm trying to get all of your guys' insight and give different type of insight. So that's yes and let's say. So the yes and is that there's there's some entrepreneurs that want to pitch to you all the time, right? So that 50 seconds cannot be like, can I pitch to you? Can I pitch to you? Like, and you have this like anxiety, you just can't. Like that will turn me off 100% because that's when I say stop, don't pitch. Like I will stop people when they're like that determined to pitch. And I know that you guys are passionate about like, let's pitch to him because I got this practice and all that. Be a human, right? That 15 seconds is like, that is like, I'm passionate about this. This is what I'm doing. I always look for on, entrepreneur, like, you have product market fit. I'm looking at founder market fit. So anything you can say, like, I've been in the industry, give me something that allows me to know that there's something about this that that nobody else knows, like the competitive advantage. Not saying I'm going to pitch to you and then say my competitive advantage is blah, 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 blah. No, it's more of like, what does that look like? So I'm intrigued in the first 15 seconds. I'm not just sitting on my laurels waiting for you to pitch to me again because I won't want it. Right. And yes, John, there is a lot of bias in that first 15 seconds. I always say, look, know the bias in the room, and you want to neutralize that bias right away, right? So that first 15 seconds, if you know the bias is XYZ, whatever it is, don't feed into it. Like you own that conversation as a founder and have them see your brilliant self in those first 15 seconds, because brilliance will outshine a good business plan every single time, right? Because that person is intrigued. They want to know more about you, not a pitch, not boring stuff, something that really incites them. I know that like when we had our first fund one event, and we had talking about all of these other angel conferences that are out there. One of the speakers says, we want the entrepreneurs to be louder than life of saying, I love what I'm doing. I'm out there. And then the investor's like, okay, I want to know why they're so jazzed about this, right? That's all, right? That is. And then you go into the 1 minute pitch and stuff like that. So I would just want to add those things as a yes and.
So my wife and I were at we did Seattle Tech Week recently, and we were at a introduction to angel investing, and there were two guys sitting in the corner standing, and my wife walked over to them and said, "Oh, you must be founders. You must be," no, she said, "You must be technical founders." And so before they had said a word, they had already communicated to my wife that they didn't know what they were doing, they didn't know why they were in the room, and that they were technical founders. Is there any kind of do I'll do the quiz thing. Sylvia, do you have a thought about why she made those judgments at a distance?
Well, I mean, everybody has bias. So I don't know what was going on in her heart and her brain. Um, Usually founders are a little bit shy about talking about their companies, right? No matter what, it's your baby. Like you're going out there and going up to somebody and says, this is my baby. Do you like it? Like in 15 seconds, and you might get shot down. That's not easy to do. That's really hard. So no matter if it's tech or not tech, I would just say that that's really hard. The tech founders are the ones that are just like maybe not that good at, let's say, talking to people, being in a room, but everybody has like anxiety or some side type of like um interest or not interest in meeting people, and that's okay. Know your strengths, right? And feed into that strength, right? Saying like, hey, I'm strong in talking about my technical aspects of it. I'm going to kind of meet the other person on the other side and see if I can have a conversation with them, even though I'm feeling a little bit shy. I always tell founders, make sure that you know your humble brag, right? Is like, what would you go up to somebody and like brag a little bit of like, hey, how are you doing? Like, I love Seattle because I love the tech scene. As a tech founder, you'd be like, look, this is what I love about it. That could open up something, and that could be your opener. Just think about those things of how you can like, let's say, bridge the gap when you get to know somebody. And if you need that help of like, what does that look like? Go see an advisor or a mentor at an SBDC or others that they can say, hey, practice with me. Know that you have people that will support you and help you get through being maybe awkward, or you get through like your that you don't know how to have that conversation. So just there's people out there will support you to get through that.
So
Yeah.
yeah, that was. Can I make a couple of comments here?
Yeah.
Yeah, no, you're
Um,
right.
yeah,
Next.
yeah. So a couple of things. I'm out in the wild a lot. So like I'm literally like on the streets, in the coffee shops, at the events, and as many of us are. And so people come up to me all the time, and I'm sure John, you experience like people bring people to you, okay, to introduce them, whether it's virtual or physical. And so I know I have lots of biases, and I know there's businesses I'm just not interested in. But what I try to do is two things quickly. One is, can I help them if they can't articulate a real problem? Like, what is really the problem? It sounds so simple, but everybody goes to the solution right away. I'm building this. This is great, and I've got a market size of this size, and I'm going to sell $1 billion of it. All right. I want to know if they really have identified a real problem. And actually, Silvia had I think it was Silvia. I saw it was like the why. Why is the problem important? Or is Naisha does this too a lot. Um, and I want to know, like, have they really discovered the problem? Like, have they spent any time on this? Or is this like just something they're living in their bubble? And tech founders have that problem. The other thing is, I very quickly in my brain say, who can help them if I can't help them? And I have discovered numerous companies that don't necessarily fall into the traditional angel investor. And we use that term. We have to maybe have an operational definition of what that even means today as an angel investor. Because I can give an example. A bakery downtown, the guy is scaling now. I just turned him on to a platform. He's going to raise another 2.5 million. He's raised 5 million. He's building a factory. Like, we would not normally touch somebody like that. But I saw somebody who was like the characteristics that Benton mentioned. It's the guy works 7 days a week. He's unrelenting with his partner. The two of them, they're a couple, and they're just amazing individuals. And I saw that from day one when they started the business. But I know nothing about bakeries. Like I never lived in that retail space. So I turned them on to some people who are experts who help them. And the number of deals and the number of companies that we see, because I'm not always looking, I should say one thing is, I primarily invest in pre-seed and seed round companies. So I'm not even looking for the Series A. I mean, it happens sometimes, don't get me wrong. I do invest in Series A, but I'm not looking for that. I'm looking for really early stage. And the one thing I know, and the founders in this room, I'll tell you, is I don't know who's going to be successful. I really don't. But I'm going to help you with every bit of tool that I have in my toolbox to send you in a place. And then what the founders, I think, need to do is know that they're being aligned with the right people. Founders go into a room sometimes, and like they tell me, well, who have you been talking to? Well, I called 5 VCs. Okay, well, that's great. Okay, but that's probably not where you want to start. If they're friends of yours, great to talk to them. You need to be talking to 30, 40, 50, 100 early stage investors if you're trying to raise capital. Like, the reality of raising money is something that I don't think generally meaning we as a community, early stage investors, accelerators, really emphasize this. I see it with like a YC. I see it with a Techstar, but I don't see it with groups like ours where we have to really say, listen, guys, you've got to be aligning with the right people and talking to a zillion of them. It's a
Yep,
numbers game.
absolutely.
And it's like a sales funnel, John. It's a sales funnel. You've got to look at it, top of the funnel, and then move it down through it and understand what that means. And they need help of people like us to get there.
Yeah. So the one of the big problems that we always see in the pitches, in the 1 minute pitch, is that they pitch the product to us, not the business. And so just as you would have a sales funnel for the product, you should have a sales funnel for the investors. And the thing you're selling is a piece of the company or an agreement with the company of some kind. And you need to build the same level of sales funnel along the way to make that happen. And often the technical founders, especially, are in the wrong conversation talking about the product, right? And so then we have trouble with that, right? So we are going to have 1 minute pitches as the second meeting for our program this year. That's 60 people going 1 minute, bang, 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 bang. What are the things that they could say in 60 seconds that would cause you to remember them when they get to the end of the 60 minutes or 90 minutes of bang, bang, bang against your head? Because at least I, being a simple person, can't remember 60 different companies all at once. Anybody have a thought on that that stands out for them about what someone did in an early thing that caused them to be remarkable?
Well, Sylvia and I have spent the last 5 years working on this with hundreds and hundreds of founders and being able to distill what you would have in a 5 minute pitch that you never get to into about 20, 30 seconds. And I think I'll give you my ultimate cheat code. And this is what I like to hear as an investor. And I think Sylvia and Bobby do too. We're all lean startup people, and we understand that maybe you want to talk about your solution, but we want to hear about the problem and we want to hear about traction. And the one sentence way to do that is say this, and you can repeat after me. Our customers love us because, and that tells me so many things. It tells me, one, you listen to your customers, you have customers, and that you've explored the problem deeply enough to turn that into traction. And that is a really solid opening line. And if you can throw a humble brag in, like Sylvia said, and like, when I left my job at Boeing, I realized we had to solve this problem. And now our customers love us because, wow, now I want to have some coffee. I want to have maybe a whole French press pot and find out what's going on there. And that is a really good shortcut. Sylvia, Bobby, other tips?
Yeah, I was saying the humble brag. That is what the definition of a humble brag is. It's a pitch, but also a humble brag of saying I was part of Boeing. One of the, as an example, the 1 minute pitch that we worked on at Astra Ventures, that was a VC fund that I had with two other partners. We were all three partners in that fund. It's like we were working with a founder that says, I was a Stanford grad, therefore I'm going to create this company and I know that people are going to come. That's not the right way of doing it. But it was like, we're building a solution for people who want to keep their hair during cancer. And as a Stanford grad that worked in medical device sales for 15 years, I know that I can do this in a different business model. What? Like, now I want to listen. It's not about me, Stanford grad, and I know people will come. There's a problem. I created a really great solution and I have the chops to do it with a different business model. Do you want to hear more about it? Kind of thing, right? That's less than a minute, but something like that on top of the format that Benton said, right? It's a typical value proposition, right? So if we hear that, and I put it into the chat a little bit of, you have to realize that investors like us, like Bobby's out in the field, I'm in the field every single time. Like I speak on these things like every single week somewhere else in the world. I hear pitches consistently, thousands, and there's patterns that I'm looking for, right? And if it's not patterned, if it's not like same, or I always say it's like plain vanilla, that we are doing this for these people to do this, to do that, then I'm like, wait a minute, I'm focused on the unpatternedness of your pitch, and then I'm off. But if it's patterned in like, this is what we do, this is a problem, this is the solution, right? And like we have a really great business model that solves it, unlike everybody else. Interesting. Like it keeps that rhythm, and I understand the rhythm really easily, and I could actually hear what you're talking about, right? So that's a little bit of playing into that pattern recognition. I hate pattern recognition. Hate it, right? Because that is why one of the reasons why women founders do not get funded is pattern recognition. But there's a pattern recognition of pitching so that you can be heard, right? If you're so radically different, it might be great, but also you might be like unfortunately silenced in an investor's mind. So just kind of giving you those pieces. David, do you want to go next? Go ahead.
I sort of want to go next, but I have a question. We're talking a lot about here's what the right answer is. Is there, a pattern I recognize is that loads of entrepreneurs are showing up and they're all saying, not all, a significant portion is saying the wrong thing the same way, right?
Yeah.
One that annoys me that I dealt with yesterday and the day before and the day before and the day before, so I'm itchy about it, is folks saying, I'm very confident in my ability for my business and I'm real passionate. And I hear that and I go, you and everybody else that I talk to, everybody's passionate. Everybody else is 1,000%, which is not possible, sure that their business is going to be successful. Like, give me a friggin' break. Like, I'm making a new car. It's going to have 4 wheels. They all have 4 wheels. You're not interested. What else is don't do that?
Oh, thanks,
Yeah.
John. You threw a value prop in there. And
Yeah,
that's what I
John.
was coming back
Thank you.
to.
Yeah, John, thanks for throwing that up. And that's the answer to Jared's question. And I just wanted to add something. And Bobby is like a master at pitching too, and helping entrepreneurs pitch. What we do at the Lean Essential Sprint Accelerator that we have here at the Brink is that we really focus on that value prop. And that 1 minute pitch is formulaic, right? I love what you said, David. You can't just come in and say, I'm passionate, because everybody is passionate as an entrepreneur, because you're not doing this because you want to really make money long term. I mean, short term, you want to make money long term, and you want to make an impact. So everybody's passionate, because like entrepreneurship is up and down and all around it. And it's hard, period. But how do you tell your story, right? Your story arc is really, really important. So yes, start with a value prop, have a formulaic template, let's say, Jared, right? And others in the room. But then it's like, what is really beautiful and unique about your story? It could be that you're from Boeing and you're doing something incredible. Then you're kind of focusing more on that. It could be that, like this one example that is a success story here at the Brink SBDC is the person who has a cold cap therapy, right? It is the technology is incredible, right? And she's been able to worry it herself and make sure that there's a better solution. That might be more of the story arc that she needs to lean in on. Maybe you've done 200 customer discovery and you are listening to them all the time, like another person in the chat. Then that's that story arc that taps into that a little bit more. So yes, there's a template. Amen to that, right? But then what is it that you can shine? Not just saying, I shine because I'm passionate. It's like, what truly is your competitive advantage and who you are uniquely made to shine in certain aspects of that template, then anchor that and make sure that you're talking about that in that 1 minute.
One of the things that's happening is that we're saying really good things, and I'm sure that the audience is not understanding them. Sort of like the doctors say, eat well, exercise, get enough sleep, and nobody knows what that means, and we're still all sick because we don't do specifically what we need to do. And so, how do we take this down to some specifics? And so, I saw that Netta just posted something into the chat. Hi, everybody. We're developing a first of its kind surgical gel, blah, 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 right? If you could find that. And that just triggered me on the telling the what instead of telling the why. We just said tell the why, right? But she's giving us the what. right?
Yeah, yeah, John. The
And
other thing is the first of a kind is one of those statements that I immediately go like BS. My skeptic or cynical, depending on how you want to look at it,
all got
flag
triggered,
goes
right?
up,
Yeah,
triggers right away because maybe they're making it better, or maybe they're coming up with an innovative solution. But I want to get, like you said, back to the problem because the richness in what they're doing will be discovered in the problem. And now, if they said to me up front in that example that we talked to 100 potential people in this space who we think might use this, and here's what they said. I mean, I'm just giving you like and here's what we discovered, and what we're going to now go to the next step, because this is a med tech. I think I didn't see the actual comment, but it's a med tech piece of equipment. Is that what they're describing? I don't know
it's
what
a
they're.
gel. It's a surgical gel.
Yeah. So and that's the thing I want to make sure that we make a point is that who is your audience? Like you just told me we're going to see 61-minute pitches. Well, that's different than talking to an individual angel investor, angel group, angel fund, strategic partner. So who are you talking to specifically makes a difference, because the pitch itself is generic today. In fact, sadly, it's becoming more and more homogeneous. Okay. Like, well, just send your AI and send me the pitch. I don't even care. Okay. Honestly, I don't even want to see the pitch anymore. All right. And so I have a different approach to this, and we don't all agree on this. This isn't, and that's the other thing you're going to find is like, we do not all agree. There is no one type of investor. I want to make that clear. We have different processes, we have different funnels, different biases. As a founder, you have to understand who you're talking to. And I like to use the investor executive summary. I like to use the 1-2 sentence or paragraph to get the intro at the top of the funnel. So I think it's there's a different approach here. There's part science, and part art here.
Yeah, absolutely. There's a lot of art here because we're in a land of uncertainty. So we're always telling a story about the greatness of what we know, and there's more that we don't know that we can't ever know in this early pre-seed. So one of the questions that I
Yeah,
want
and
to
John,
make sure,
you asked like what was specifics? I mean, what are you looking for specifics? Because we can go into specifics as well.
yeah. So
Before we
I
dive into, so back to Netta's quick
Yeah.
pitch there. We talked about product first and how that doesn't work. This is not a bad pitch. It's just structured kind of backwards, right? So if you could lead off with, we're wasting billions of dollars in healthcare costs, and there's a simple solution that has huge effects, something like that. And this is why you're doing it, right? And maybe
well,
you
and
can
and
weave in.
the grounding in expertise as well would be useful here.
Exactly. And if you can talk about a personal story, how you came to create this company, how you came to create the product. Maybe it was a loved one. Maybe this was at your previous job at Cedars Sinai or who knows where.
But so
Then,
at the beginning, we're gonna think about team and idea, right? We're in the room, someone says something, and somehow in between team and idea, we have to decide that we want to hear more, right? Now, is the idea about the product or is the idea about the benefit, right? What motivates you to have that second minute worth of conversation?
yeah, I think we all look at decks and meetings and pitches a little differently. We all have probably our 3 to 5 things we really hone in on. Silvia has a really good one that is M. How many M's?
The five M's and then
Five M.
the two extra M's. So that's more like a 1 minute pitch.
The
But yeah,
M&Ms.
you're seeing that all of us actually, even on the panel, have different things. I would not want team first. Like I would want to know what's the problem,
That's
right?
Well,
crazy. Team first. Has to be team first.
but
Yeah.
example is that Benton started off with, in the 15 seconds, I want to
Yeah.
know that the founder's committed.
Yeah.
Fundamentally a team question.
Yeah,
All
Yeah,
right. So,
I was going to say one other thing. I also like to hear with the problem. I like to know who they think it benefits. Like, is there a benefit? because especially technical founders, they're busy designing features that just could be meaningless, and they haven't really articulated. There may be benefits, but they're not. If they're unable to articulate a benefit, then generally speaking, nobody's willing to understand it and pay for it. And I'm being really extreme in that comment. But if they need to be able to articulate a benefit, and benefits are not easy for people to get to. This is a
Right.
this is a business problem that goes beyond founders.
Right.
So how do they get to that benefit and articulate? In this case, like the surgical complex, yeah, there may be billions of dollars wasted, but is there a benefit to someone? Like, does somebody care? We have lots of problems in the world, but nobody understands the benefit or can get to the benefit or believes the economic model. And by the way, I get to the economic model really quickly in most cases. Because if there is no economic model, if I can't see it or investors can't see it, then we need to look somewhere else. And that's why there's a circular conversation here. We very often go back to the problem, because they've gone to the solution. There's no economic model. And now we're back to the problem again, because maybe there is something there. But if we dig deeper, then we find an economic model that maybe makes sense, as opposed to some cut and paste subscription method or whatever it is.
Yeah, and there's a good book by David Parker called Transaction: Startup that goes through 15 different revenue models that can be the foundation of that economic model that most people don't look at more than one or two. So it's really worth, thinking about that deeply. But let's back up a little bit to a question where people were talking about what do we mean by traction along the way, and does traction end up in that first little bit of the conversation?
Benton and I, we're going to banter, Benton and I.
Yeah.
So Benton, did you see my comment in the chat?
Yes.
I gave them your traction.
Yeah, you get
Please.
the VC version, right? And
Yes. So yeah, we Benton and I have different perspectives, so that's awesome. And it depends if you're pre-seed or seed. Depends on the industry. It depends on the geography. So as Bobby said, investor relations is an art. Also, trying to figure out what your true traction is part of founder market fit and understanding what the traction is that is perfect for your company and the strengths that you have. Because if somebody tells me there's traction is community and they're a tech founder that always is in their basement, I'm like, I'm going to call that as you don't have that. Like, what is it? So it has to all align, right? So traction for me, traction for Benton is revenue, right? Period. And my traction is also revenue, but I'm also pre-seed. So I understand as an investor who's seen thousands of pitches, a pre-seed company, if I tell them what's your revenue, then they're like 2 years from now. I'll give you another example because I know John likes examples and like not just like way up there is one of my portfolio companies. She's a medical device and she wanted to go into clinics. And it was hard for her investors to really say your traction is not revenue. You're not going to get to revenue in like 2 to 3 years. So she actually pivoted and became a consumer product just to have the revenue of sales of her medical device on her website. I would say like 15 years ago, that would never have happened. It would be like, okay, revenue is down the path. But now investors are looking at revenue even sooner, pre-seed. So anything that you can do to make sure that you are looking at revenue, that you can get early revenue, paid pilots, something on your website that is early sales, anything revenue generating, even if you don't get revenue up front, but you are saying, okay, I have these many freemium model user people coming in, but I have a tiered approach that they can buy $5 of premium because I know that they really want X because I'm building it this way. Let's say another company here at the SBDC is building out a AI baseball training app. He's doing incredible, right? So he knows that he has all of these free users coming in, and what they want is they want to be able to video and record one swing. But if they get 2 or 3 or 4 swings evaluated, they really like that. And the transition is between 2 and 3 because he's done a lot of customer discovery and he knows exactly as he's bringing these free users in exactly where they stop. And then he goes, okay, between 2 and 3, I'm going to have them pay revenue, but based on the founder market fit and the product market fit. That is like that really magical place that for companies that are pre-seed. So I'm looking at really pre-seed. Seed is like you need to be revenue generating. I'm sorry, but in deep tech and in life science and that I know that happens 2-3 years down the road. I understand that. Give me a reason why you're going to get early revenue. That's my traction
You,
is, yeah, Benton. You can
you know,
banter with me.
well, can I banter a little?
Go,
Yes.
Bobby. Yeah, tag
See,
in.
in pre-seed, I use the word milestones as opposed to traction sometimes. And the reason I say that is you as founders sometimes don't even realize that you have these milestones. So you've been working on something for like a year, okay? And maybe you had a little friends and family money. Maybe you've actually went out and talked to 100 potential customers. You've looked at the marketplace. You've built a product. You've actually sold a few of them, but you don't think much of it. I think you need to, if you're talking to the right investor community, you need to let them know that that exists. Those show forward motion. You're doing something. You didn't just scribble something on a piece of paper or made a beautiful deck that you're showing everybody. That is important. Now, in different industries, it's different types of traction. Example would be I worked with a company here in town that when they came to me, they had been working in stealth and they had gotten $20 million from the Gates Foundation over a period of years. That to me was a signal, okay? That's a signal, okay, that says we better look closer at them to see where they're going. Now, that doesn't mean that everybody's going to want to invest in it, but those are the kind of things, non-dilutive capital in specific industries, especially in life science, SBIRs, getting someone else to validate we're doing. In fintech, it's about having strategic partnerships with large institutional organizations. And I invest, like I said, in a lot of those places. And the fact that they have a deal with Goldman Sachs makes a difference in the next round, which led to this company specifically that just raised $10 million. So I think those are the things that we look for. And again, it is very different. Pre-seed and seed rounds are quite different. Series A is a totally different game.
Yeah,
And
absolutely.
you want to jump in there because you might have a
Well,
different view.
you
Always,
you
I'll be
you
quick,
you
but you
guys
both.
you guys like talking to each other a lot, and we've blown past our 30 minutes, well into
Okay.
Okay.
our 50 minutes now of this thing, and we've had a bunch of people join us. So I just want to sort of welcome everybody here. And I think this is really a good conversation, so I don't really want to disrupt it too much. So rather than doing the breakout we would naturally do here, I think I'm going to just keep right on going with the conversation. But I want to move us from the front of the funnel up. Now, we've done the at the beginning so that you get to the ones that you want to care about. Now you're going to do some due diligence and pick one, right? And you're going to get kind of specific in some ways about what makes someone interesting to talk to versus what makes someone investable. And let's dive in a little bit more. You've been out out in the wild doing this searching. Someone has said things that are interesting. You invite them in. You have your coffee meeting. You chatted on them, and you decided, okay, I need to introduce these to the rest of the team, and we need to go through the screening committee or whatever the filter is. And now we're going to do due diligence on them. What are we doing in the screening committee and looking at that? What are the things that we're doing in the uh, decision making on due diligence that are things that we would compare the different kinds of companies? So we're trying to, in SAC and SDAC, we don't have sector bias. We have, arbitrary companies. The only thing we limit is how big the company is in the raise. And so we could have an Apple company or we could have a Zebra company, and we try to compare these things to each other. What are the different aspects that we're doing that on, right? So in your banter, Benton, back to Silvia about what you're doing back and forth, take a step down deeper into the due diligence or the screening committee and say, what are markers that are useful for these different companies?
Okay. For traction, my version is revenues, users, and growth. And like Bobby and Sylvia said, it's a signal to the market that you're moving in the right direction. That's very different for different industries and different stages. It's more of a VC software perspective. And when you get past the, okay, tick the traction box. Something is happening with the company and these founders are moving forward. And you want to get to screening committee, start talking about really technical areas of risk. There's 10 general areas. I always start with the team because a terrible team can ruin a great company. And I want to make sure that the company is run by people who are experts in their industry and that they also love each other. And that's a high bar to me because I've seen dysfunctional teams just really screw things up. So I have to know, one, for me as an investor, I'm going to be working with this team for the next decade. Am I comfortable with that marriage? Are they, and I like to, see them in different settings. I want to see them at lunch. I want to see them at midnight. I want to see them with a few drinks in them sometimes and see how they get on with each other and know that they're collectively going to be unified because that's one of the most important things. And then I also like to see in a team, when I'm breaking down team risk, is that they understand they don't know everything, that they're coachable. They might be really great. They might be the world's best PhD in battery technology, but not know a thing about employee stock ownership plans. And that's totally fine. We can figure that out together. But I don't like for that PhD to say, I've got it all. Don't worry about it. Just give me the money and I'll run. So I won't go through all 10 of the big risks that we analyze. That's just the first one. And it's number one for me because I've just worked with a lot of teams and seen great teams can figure out a way around the problems you don't know are coming. Anyone want to?
Yeah, I would just say that with teams, I agree with you. Teams are really important. But after having a couple of sessions, let's say the funnel's now moved to the point where I'm interested or the group is interested, I want to know whether they are listening to the conversation, whether there's movement in any direction, and whether they can make their own decisions. I always like to say, like, I'm just one voice in the woods, like do not take everything I say as gospel. Make sure you're spreading your conversation around to other mentors, advisors, other founders who are going through the similar experience, angel investors, and then you make a decision. I want to see that they're capable of making a decision. I hate to compare to children, but in a sense, always felt as accomplished when my children are capable of surviving on their own in the wild. Okay. And whatever that might mean to everyone in this room perhaps is different. But the fact that they can feed themselves, take care of other members of their family, and lead productive lives and create joy in their lives. And it is an interesting thing. Like, we don't talk about this a lot. I know some of you do. I know the people I work with do consider this issue, but there is the joy factor. And a lot of us do participate. If there is no joy in it, then the chances of me working with someone is like zero. It really is. And I'm not saying I won't turn them on to someone who maybe is better aligned, and I'm not being like, I'm not trying to ride my high horse. It's just, you want to work with people, you're going to have years of relationships with them. And as founders, my advice to founders is realize it's not a transaction. Okay. It's not a single transaction. If you're in it for the game, you're going to be in the ecosystem. You're going to be building relationships with other people. And who knows what those relationships will evolve to. And I can tell you stories. I won't spend the time today, but I can literally tell you that I met people 30 years ago who now have popped up in my life, okay, unbeknownst to me. Kathy Poocher, you guys know her. I've known her since she was in the semiconductor business, and I had no idea that our paths were so entwined. And so the good things you might have done then, or the bad things you've done then, will come with you. And with investors, it's an eyeball community. It's a tight relation. I suspect, John, in Seattle, it's similar as it is in San Diego. We know, a lot of us know each other. And we will support the companies that are founders who communicate, who we know that things aren't easy. We know that they're going to go through, like it's not all smooth sailing. And they're constantly going to need help, whether it's capital, strategic relationships, whatever it is. So that's really, really important. Silvia, any comments? Because I know you build a lot of this.
Yeah. All of the all of the things that you're hearing here is values alignment, right? With values of impact, values of integrity, values of trust. Trust is the most valuable currency. That's tremendous reciprocity between you and us with sincerity and transparency. That's trust. That is what the ideal currency of this investor relations. So if you're thinking pre-seed, seed, top of funnel, bottom of funnel, going into due diligence. I love due diligence myself. I do like 40 plus hours of due diligence just with my own like investment, not as a team, not as a group, not as that, just me, just because I'm a scientist. Right? I'm a scientist. I am a geek, right? I need to know all about it, but I'm trying to de-risk my investment. I'm always optimistic. I want to know why you're so strong in these areas in the different aspects of the due diligence process. But it's also in the gray area in between. Is that, do you answer my emails with respect? Do you answer them with a good amount of time? Do we have great conversations? Can you not pitch to me? Can we go through your financials? And I want to go through every single one of your assumptions. I really don't care what the numbers are. I really don't care because they're all going to be wrong in about a month, right? But I want to know, did you think about all your assumptions? Are you saying my CFO needs to come in here to have that conversation? Oh, no, I want you as a CEO to understand your numbers, and I want you to feel them. I want you to feel your customers. I want you to build for your customer. So it's like the 1 minute pitch, the top of funnels, like you have to just do all the things. Is like, not be same, but be same. Be formulaic, but not be formulaic. There's so much art in that, but it's like those are kind of more transactional pieces. When you really go into the next level, it's really relational and really making sure that when I write that check, it's because I have met you probably 20 times. We've gone through a lot of different things, and I'm betting on you. I'm believing in you. I'm believing, even in Series A, I'm believing in the team. I'm believing in the company that is you. Pre-seed is you as a founder. So those are the differences. And I think the last thing I wanted to say was that, like, it's about, and we've talked about this a little bit high level. I'm sorry, John, but the 3 C's of capital, right? You've kind of heard this. If you just focus on those 3, it's the financial capital. You need to make sure that you know how much money you need to go into, and you need to transact on that. That's that capital piece. Then it's relational capital. Who do you know? What is your network? Don't like break trust with your network, because you don't know where that person comes back. Like, I mean, you see David, who like has been an entrepreneur and now he's back doing on investor stuff. You never know who's in front of you, who's in back of you, who's inside of you when you're doing all of these relationship building. So financial capital, relational capital, and experiential capital. So the people that you worked at Boeing with and you did that project with, those are the people that can come alongside you, and you can actually not ask for so much money because you can get that CFO or that CTO at a lower rate because you know what kind of experience they have, and because of the relationship that you build, you bring them in, it's lower cost. Then your capital that you have, a financial capital, is being shepherded more efficiently, right? So those are all those 3 C's. If you're thinking about all those things, how do I amplify that and how do I de-risk so that people are like, yes, this is what we want to invest in?
Yeah, absolutely. So you are out in the wild, you find a company, you like the company, you drag them into the screening committee. The screening committee is filtering. And now the Angel Conference uses pitches and reviews as a screening mechanism as a whole group. But most angel groups just have a handful of people where you pitch and have a conversation, and then it's essentially a one-time conversation, whether you get screened into the presentations. Um, are there specific things that if you see the thing about the business that you just want to walk away? Is there a red flag thing in there somewhere?
We have a laundry list of red flags, but I think for me, like one of the things that I look at is the opportunity, and that's a little bit broad, but it has to be an investment that can return 10x or more. because the opportunity cost of capital is not infinite. And that's a go, no go. So if it could be someone that I really like, great team, great product, and they're going to grow at 10% per year. But it's a pizza parlor franchise model. I don't know. Could be great for the operator, but it's not going to return venture type returns. So those are one of the, not seedy black flags. That's just a go, no go decision. And that has to happen really early on. So I like to try to get to that in the first pitch and find out how big can it be. Big problem, big solution, big returns that justify
So,
risk.
So,
so
so John, for me, I look at participatory deals. So I do exactly what Benton does on the kind of deals he's talking about, traditional angel. But if I see cash flow opportunity, I see margins that rationalize it, I'm happy to lend them money or have a combination of equity, warrants, whatever. I've done all different options. Sometimes it's short term, sometimes it's longer term, sometimes it's structured into the company's already created structured deals. There's many founders that have structured deals that are done on platforms now. But I look at every deal as an individual. People need capital, and there's different ways to get it. And again, from the founder perspective, I have clients that have raise capital through equity. They have equipment that they bought through equipment loans. They have SBA loans that help them get a physical location. Like I'm not giving an example of a specific client that they built a custom machine, $2.5 million in China that's being shipped to a place in Utah that they raised other money for. They've had like 6 or 7. They took their own money out of the equity they had in a house. I mean, those, by the way, are committed founders. Those are founders that are putting and those are the ones who, honestly, I put the extra effort out for, because I know they have a big market. They have a real excellent opportunity to succeed if they can find enough capital, along the
right.
way.
Yeah, I would.
So you said something really important. Sorry, Sylvia. That the deal terms can make it a reasonable investment, even if it's not the VC equity pathway that Benton articulated. And Looney Libs, LUNILIBES, sorry, BLIBES, yes, that's correct, wrote a book called Revenue Redemption, which talks about the mechanisms of that. So, Bobby, when you think about your investments not as a 30x return, but an IRR, what kind of internal rate of return on one of these other kinds of deals would make it a worthwhile investment to do revenue
Yeah.
redemption or a
So
loan or whatever?
yeah. Well, with a loan, the model's completely different. In other words, there's a different risk assessment. Um, so the question is, am I doing it a deal where the money comes to me first and then I distribute it, okay, um, from customers, or is it where they're paying me interest on it, and are they paying me regularly? What are the terms? So a lot of the structured deals, like if you go to platforms to do this, and any founder can do this. I'm not recommending it, by the way, for most founders, just so you know. It's very, very specific to people who really have an ongoing, perhaps a business that will only be $1 million or $20 million. That's not something that's going to be traditionally what we think in angel as the 10 times type business. But the structure could be a simple straight loan. They pay 15 to up to low 20s in terms of interest. Every state, by the way, has statutory rules regarding what's the maximum interest rate you can have. There are actually lenders that do this in a more structured way. I'm an individual, okay? But there are lenders that go, like in San Diego, I happen to invest in a company. They call themselves Bank of Cardiff, but they loan money out in this structured way to become it. But these are typically on the fringe. They're companies that eventually would scale with the kind of companies Benton's talking about. So when you talk about specifically the Brink, okay, our role, that's not our typical customer, but as an investor, and as founders, some of you are going to fall into that category. And that's where I say you need to think about different ways to run your businesses, and capital efficiency, and when you need capital and how you need capital are part of it. So there's a strategy, there's a plan, but there's then the reality of the world. The macroeconomics of the world affects you significantly. Interest rates that are higher affect you. If the stock market drops by 1,000 points, investors panic. Okay, they're all of a sudden think, oh, I don't have money now. That may be true or not true. Okay, their bank accounts and their funds may be as rich as they ever. If LPs, limited partners, just for those who don't understand that, because some of you are new, limited partners in funds are waiting to get their money back in many of these funds, which means maybe they don't have capital right now. So those are just some examples.
Yeah,
Yeah.
I want to just add something to that too. I know that this is like on the entrepreneurs out there, they're like, I don't even know how to even get started on like figuring out like an SBA loan and this and that. I think at the crux of all of this too is that, and I put in the chat a little bit, if I hear from a founder that I'm just waiting for my angel to come in and then I'm going to meet milestones and then I'm going to do traction, that's not the posture that I would recommend. The posture that I would recommend in all of this is that I'm learning as I'm going, and I'm going to have a community that helps us, right? So let's say you're like, look, yes, I'm all for trying to figure out all these financial aspects of it. Meet with somebody like Bobby, meet with somebody like the SBDC advisor that allows you to understand that, and that posture of openness, no matter where that goes, that investor is going to be more like they really want to invest in you because you are thinking outside the box. You are thinking about how do I do it differently? And you've heard a little bit around here of like, hey, when you go and do this one thing, come back to us, figure out what capital efficiency. Being open is a very easy, you can do that today of saying like, how can I meet with somebody that will help me feel like I can go after this one loan? I've done a lot of factoring, right, with entrepreneurs. That's kind of similar to what Bobby does, is
Yeah.
that especially CPG companies, is that do you have this manufacturing like challenge? An investor can put money down to have you have that manufacturing actually show up at your doorstep so that you can sell the product. So then now you can talk to an investor saying, now I've had 3 or 4 manufacturing runs because of this factoring opportunity, and now I can go forward. It's that thought process of being open to optionality of where you can be capital efficient and grow your business in a way that is good and going one step further. That's that openness. So you can do that today. It's not that you have all the answers. You just have to be open to opportunities to be successful.
Sylvia, one of those things I just want to comment on. I think you build a lot of relationships when you do factoring. It's really built on usually long-term relationships you built with someone, because there has to be a lot of trust to have that relationship. Because the financials, honestly, in early stage companies are difficult sometimes to get to exactly what's happening. So if you don't trust that person, it's never going to, you're not going to lend them money. It just isn't going to happen.
And yeah, so one of the things that I'm hearing is that there are a bunch of different pathways, and you should think about it. But when I think about angel investing, we're happy when we get a 25, 27% IRR. And if I can do a loan where I have some kind of revenue redemption mechanism, or I have a venture debt mechanism where I can get my 15 to 20% at a lower risk because I'm investing in a company where I can see the foundations of the business a little bit better. I'm happy with that. If I get 15% IRR, and I get 3 or 4x my money back in 5 years, right? That early things with good IRR is perfectly fine for me. Does that work for you as well? Do you like shorter deals with more risk reduced things?
I like single doubles, triples, meaning like I'm not always looking for the grand slam out of the park, or the World Cup championship, because most deals aren't that way. But it would be nice to have some of those. And I obviously do invest in some companies that I believe could be that, have the potential for it. But those are so small. if you realize the public markets, how few companies go public, okay? And some of you probably do aspire to go public someday in your minds at this point. And there is not one, as you'll learn, if you don't know, there is not one way to go public even. There isn't like just, oh, you go New York, NASDAQ. There's actually different ways now, different paths you go public. And some are really good for investors, and some are really good for founders, and some are just terrible for both. And like direct IPOs today, there's lots of them going on, and they're awful. And so, but I'm not telling you shouldn't do them,
They
because
don't
maybe
have to
your
be
company.
awful.
Yeah, but
They
but
they
most of them
they they are done
most of them
badly.
are
Yes.
statistically most of them are bad. So I'm not saying that they'd be bad for you as the founder. So my only point is, this is just, you have so much optionality, and part of being an early stage founder is like, where do you spend your time focusing? So we've talked a lot about it, a lot of different things. And the key thing that I always say is, just please identify the problem and who your customers are, and build the team, and you'll get to, because you can't do all these things as a solo or even 2 or 3 founders at the same time. You have to really prioritize what you're doing. It's easy to get lost, and take action. Don't sit. Like, I'd rather you like fail a little bit along the way here. All right. And I think Sylvia kind of alluded to that, sitting in on your computer, telling me that you researched the problem completely is not a good start to the conversation. All right.
So you guys are um, we're all working together in this nice tight thing with an SBDC that knows what the word startup means. We have Kevin Grossman here, who's going to post in the chat, who's with the Washington SBDC. So you guys should talk to each other a lot. That would be really helpful. But let's dive just an inch deeper into this. You're looking at companies. One is a pizza parlor. They're going to scale. They're going to go nationwide. They're perfectly profitable now. They need cash to go nationwide. Benton's going to say no. That's just not the industry I care about. That's not the kind of investment I want. Bobby's going to look at it in a uh, individualistic sort of way to see if there's a deal that makes sense there, because he's happy to have a double, triple kind of thing that returns money quickly. Sylvia, do you look at those kinds of deals? Are there deals that you'll just turn off just because the structure of the deal is not correct, even if it's a great team and even if it's got a good market size?
Yes, because I'm a smart investor. Yeah, and I think that one thing that I would say though too is that it could be that the deal is off a little bit. I usually talk to the founder and I'm like, hey, do you realize that if I'm gonna say no, your whole round's gonna say no. So let's like work through this. I think, and then if that founder's like, no, this is what I have, I'm like, I'm sorry, I'm out. But if they're like, oh, what is it about the deal that you don't like? I'm like, these are the things. And they're like, okay, they can make the decision on, I might not be the right investor for them, right? Because another investor would like the terms to be different, like exactly what they want. And that's okay. It's okay to say no, and it's okay to say yes to investors. So I think I would say that, yes, I do have my limits. I do want to make the best investment and have the highest return, but I know that pre-seed is hard to even evaluate that. I love deep tech because it does have the highest return on investment, but that is like, I'm still waiting 15 years later for one of them to make to make it. And that was my first investment check in 2020 and 2010. And it is very deep tech, and it's in like viral technology, basically, and cervical cancer. So yeah, I'm still waiting. But that was probably my biggest check of all, which I also learned never write a big check. But it's one of those things that I did, and my assets and my liquidity is tied up in that. Going back to what Bobby said, right? So yes, I do have like, I really want the highest return. But I've also been on the investment committee of Next Wave Impact Fund that we were looking at deals that were just 8x. And I was okay with that because I'm learning as an LP to be part of an impacts driven fund that will look at least an 8x return and that 35x return. So I love to have a diverse portfolio of companies that I'm looking at. So I don't have a determinate answer to your question of saying I'm only looking for this. I'm looking at the great my entire portfolio, seeing am I okay with a lower return because of XYZ, but I will always look at the highest return on investment for me. But it's also about return on impact, and they are not separate, and they're not like I need return on impact and I'm going to decrease my return on investment. I want them both to be at the highest level because I expect quality from my entrepreneurs that I invest in.
Yeah, if you don't have quality of impact, then why are we doing this? And if you don't have financial returns, how the heck can you get the impact you want? So,
Yeah.
the both of them together is an amplifier for me. But let's pull the layers out a little bit here. Um, all of these people have this notion they need money. A lot of them have the notion they need money and they haven't done the groundwork to get to the point where they can get money, right? Like, give me money so I can build it in my garage is like a non-starter for most investors. But they're going to also say, oh, I'm going to just raise a safe. But we've just said a bunch of things where a safe would be exactly the wrong instrument. And so let me pull that apart a little bit. So a safe does not define a price. It does not make it stock. There's a whole bunch of things that happen with a safe that are all dependent on the next round. And one of the things that founders tend to do is take a safe and then another safe and another safe, which cause its own set of problems. But if I'm not going to take VC money where it sets my price at Series A, then taking a safe at the seed level is not a reasonable answer, right? So if I'm doing the pizza shop and safe are like can't work together at all, right? So are there deal terms that can destroy the conversation, even though you're interested in the product, you're interested in the impact, you're interested in the founders? Anybody got
Sure.
it?
I mean,
Go ahead.
sometimes valuation is a non-starter for some of the groups I'm in. We've passed on deals that we thought would be fantastic in the 20 million range, but they were at 150, and they had 90% of the round and a lead investor locked in. So it was a take it or leave it deal, and we've passed on those. And usually that's worked out fine. There's a few we've missed on. I think one of the biggest non-starters is an uncapped note, because you really don't know where that's going to lead, and no amount of founder love or good coaching is going to fix that one. You're really just throwing the dice and hoping that the kind world of venture capital saves you, and that's not going to happen as an angel. So you really have to have a cap. That can be a spirited discussion, and I've seen deals fall apart where the founder and the investor don't agree on what the cap can be, but it should at least be that negotiation, not an open-ended note. And then when you're dealing with stackable notes, that can be an issue too, because you might think that you have a $10 million cap, and 9 safes later and 2 years later, it's turned into a $30 million cap. And you don't really hear about it too much because the notes are just stacking safely. And you're getting the LinkedIn updates that, oh, we raised another $1 million. Things are looking great. Traction, traction. Then you realize, oh, we've been diluted 9 times over. So yeah, valuation matters, and the structure of the note does matter, especially when you're getting into Bobby's world of um, shared revenues and ratchets and all kinds of balloon payments, right?
But so Hall Martin at 10 Capital out of Austin, Texas, has a 3x3 model, right? He's going to invest in you with a note of some kind. He likes notes instead of safes, but a note. And then at year three, he's going to look and see whether or not you've made the progress that you said you were going to make. And then he's going to either ask, double down on a priced round with you, or he's going to ask for you to take him out based on revenue as a percentage of revenue and build up, I'm an outward path or a dive deep path, right? Is there any of that kind of experience in your interactions with people?
Bobby, you want to?
So Bobby's the adventurous terms guy.
Yeah, I think we're all adventure capitalists in this game,
Yeah.
but
I've
Bobby
only like
I'm
says,
sorry. Yeah, go ahead.
I've only invested in one company out of 150 companies. That was an uncapped safe. And as Benton said, and they're doing incredibly well. So it's like I did good, I guess. But I knew the founders incredibly well. They went through our accelerator at Stella Foundation, had multiple conversations with them. I knew their posture. I knew what they were going into. I knew what their next round was going to be like valued at. They were doing more like friends and family, like the comments in the chat. So that's what it's like Benton said, it just depends. You have a great conversation, but when the conversation is like, I'm going to do an ANCAP safe, and just because Y Combinator says it and I can do it too, that is a non-negotiable, like, thank you very much, click, done, right? So again, it's the posture that you have. If you have that posture of openness, having conversations with investors, then you can see like, why are they not liking this? And oh, this is going to be my first check-in, and she or he has a challenge with it. Why? Oh, interesting. I didn't know that. Then it's like, whoa, that conversation, that gray area between you have an uncapped safe, I'm not interested, to like, wow, we can actually change it to be a capped safe. Interesting. I'm learning a lot. That posture will allow that investor to be like, they're willing to be coached. They're coachable. That's number one in the team dynamic piece, and then more conversations to lead to an investment. Bobby, go.
John, in pre-seed, there's a few things we know, but very little we do. And one is the future is undetermined. And so, what does that mean for the pre-seed investor and for the founder? The founder should have some sort of idea of what their capital needs might be in the next, let's say, 24, 36 months, but that's all guesswork, okay, at best. Some a little more defined based on the kind of business or where they're at. So early on, if it was the first round, the first problem, and I'll say this to founders, is what kind of investments have you taken from family and friends? Think about that. Like, don't think about that lightly, because you have to live with them. So, if you've given away 20% of your business to them because they built your website or they gave you $5,000 for lunch, and that's important, by the way. I'm not minimizing it, but the reality is that will be renegotiated, okay? Because it just doesn't make sense, all right? Or signing on to a co-founder that's not really a co-founder. These are more problematic issues that I find are quite common in early structural companies. Let's assume they're a C corp already, just for this discussion. Now they could be an LLC. That's a different conversation, and I'm sure, John, you guys probably talk about that. But I want to point out that as investors, at least as early stage investors, I go like, the next round, and we've had examples. In fact, Benton can talk about, we can mention a company that begins with the letter O, okay, that we invested in, that had a classic down round, and then some of us got back in, rode the pony, and I don't know where they are actually today, but I know they turned around and they seem to be doing better. At least the last report did, and that's the classic example of where, as investors, we get in and out of these deals sometimes. Like where sometimes they go to zero or near zero. Okay. And as founders, I would say to you, you need to have the dialogue. People realize just because investors gave you only $5,000, they may actually be a critical investor downstream. So keep the communication going up. And as an investor, we want to be able to be part of that decision-making process. We know that you have other scope, and I'd rather have a down round of a company that I think now can be $100 million than no round, or no opportunity to participate in something, because I can't predict where they're going to go. And so I don't know if that answers the question here, but early on, those decisions, I will say, whatever decision you make early on a safe, as an example, does have implications, but I don't care. Like some people care, well, how many people on the cap table? I could care less. All right. I have companies I've invested in, they have 10,000 people on the cap table. And because of technology today, it doesn't matter to me that there's 10,000 people. I want to be direct. I do, philosophically, I want to be directly on the cap table wherever I can. All right. And I have lots of different reasons why. some of which are just ego related, and the others are more substantive that I have direct communication with the founder so I know what's going on. All right. And it's not like I can influence when a founder gets to a Series A and you're going to raise whether it's 5 million or $50 million. I'm not playing in that game. Like I have no influence or little influence in that typically. And almost everybody prior to that investment typically have very little influence at that point. And I'm not saying there aren't exceptions. There's pro rata rights, there's structural things you can do that as founders, you can give your early stage investors, but everything has an impact later on. Giving early stage investors certain rights could mean that the next round, either you're going to have to get them to give up those rights, or you may not get the next round of money that you want. And it's the guy who has the check, the big check, the money. At least my lesson, bet maybe you have a different story, John. But the guy who has the biggest check at the right time usually has the most influence in the game.
We often get put and I think intentionally so, we often get put in a situation where it's a take it or leave it deal, and the deal sucks for the earlier investors at some discount to what we expected, but we have to decide whether we want to kill the deal or not. And it's very frustrating when we're, essentially a sharp stick in your eye, to decide, I'm going to take the deal because there's no point in killing the company over this.
But I want to say one last thing to the founders on that. That's true. But I want to say to the founders is like, remember, this may not be your first ride. You may not be, you may be last ride. You may be having, multiple companies. And building relationship with early stage founders is fundamental still to many founders. And so being an advocate, and I do have founders who are advocate for the early stage investors. I'm not saying they always get everything they want, but they do carve out things that help those early stage founders get return because they want them, or they build relations. These are their friends. Like you're living, usually early stage founders, you're living in the community with them. Like you're living and breathing with them. They are participating in some of them in your business. Unlike the machine, which is very effective, and they'll participate in too, but it's a different machine that you'll be operating. I know Benton, you had something probably to say on this, and lots of experience.
Good point, Sabi. I'm not going to add to that, but I'll loop back to one of the founders was asking how can we protect ourselves, and it ties everything together. John mentioned the most common terms that we look for, and one is information rights. And that's an investor's right to receive a monthly or quarterly newsletter. Very basic concept. And I will tell every founder out there, try and make this monthly. If it's quarterly to start, that's okay, but try and increase to monthly because, like Bobby said, you don't know which of your $5,000 or $10,000 investor is going to open up that door to a major corporate deal that saves the company. You don't know that $5,000 investor, when things are rough and you've had 2 years of conversations and 2 years of really good reporting, they might write $100,000 or $250,000 check or bring their group in and write a $2 million check. You don't know, but what you can control is getting that information to the investors. And I love getting information from a startup that's not doing well. Like it's great when you can say, "Oh, all of your traction, all of your forward momentum is the exact same thing I see in your posts on LinkedIn." That's wonderful. Good for you. Maybe I'm not necessary and you're growing, but what I really can help with is a founder that says things aren't going well. We lost one of our co-founders, or we lost one of our key suppliers. We're really struggling with this. Do you have any expertise here? And then we can open it up to the network, and there might be 500 people who can help that company. So control what you can control, build on that trust, and it starts from day one, from the very first conversation. I can tell that you know what you're doing. I can tell you believe in it. I can tell that your team is together. I trust you. You trust us as investors enough to receive our money. And that trust is going to continue to grow over the years. The first 2 or 3 years post seed check writing is an absolute carnival, an adventure no one can predict. The future is always unwritten. And the one thing we can guarantee is there are no straight lines in startups. And we can help you get there, but it's not going to be direct. So if you communicate with us and give us information rights, then we can help you grow without having to do down rounds and without having to get a venture capitalist that kind of is a predatory stalker and deals with distressed companies. And there's amazing support system for you, from all of the angel groups, all of the SBDCs, all of the ecosystem partners that we have in San Diego and Seattle. There's an incredible network. I didn't have this network 15 years ago when I was starting my business. I had to pay for advisors, I had to pay for consultants, and now we have all this for free. So take advantage of it. But remember, you're responsible for how you behave. And we've had a lot of companies come back for another check a year or two later. And that's the first time I'd heard from them since we made the investment. So that response was pretty easy and quick. Now, the ones that have communicated, maybe the companies were on a similar trajectory, having a tough couple of years, but the ones that I knew personally and had communicated and had shared, like we're having these troubles, we did invest again, and those companies got over the roadblocks, and they went on to raise venture capital and are doing the right things. So communicate is something you can really control.
So as a founder, I just want to say one last thing. As a founder, when you meet people who are investors, you should ask them, is it okay if I communicate with you? I don't care if you meet them at a cocktail party, you meet them in an environment like this. You should ask them, and you should build a list, and you should communicate gently with them in a way that they want to be communicated with. When I get updates from companies now, I use Claude to analyze it, looks through my emails every day. It says, are there things I can help my founders with who have sent me stuff? It doesn't mean I act on every one of them. I can't humanly act on everyone, but it flags me on their needs. And if I have somewhere in the network, I can shoot an email out, or I can request something, or I can think about it the next time I'm in the room with someone else. Top of mind should not be underestimated in a crowded space. And in our ecosystem, I assume it's similar in Europe. We as investors and as founders, we hike together, we surf together, we go to coffee shops together, we go to events together. It is a community, and I don't want to overuse the word joy, but that is part of our experience. Our part of experience, we like seeing these people for the most part, and that's that's what you want. You want to have a community of people that when they see you, they're not running the other way because you just need money or a strategic partnership, but they want to hear what's going on with you, and they want to try to help you in whatever way that can be.
Yeah, great answer. I want to ask one more question, then I'm going to take us off spotlight and try to get whatever questions that are unasked asked. We're talking about the uncertain relationship between VCs and angels, and I'm beginning to believe in the singles and doubles kind of company, that there's a pathway that doesn't involve going to venture capital. And I'm beginning to call it a one and done angel investment, where you use the angel investment, you build something that's valuable, you use the angel investment to crank yourself up so that you have enough momentum to own a niche, and then you don't take any more money. Have either of you thought about angel investing as a one and done instead of investing to be at the coattails of venture later?
So yeah, I have actually a lot. But we're not there yet where I believe I can capitalize. So I have invested in companies, and I'm trying to now move them towards digital assets so that they'll eventually be traded on platforms. But that for most of you, that's probably 3 to 10 years out. The platforms exist. There's 6 SEC approved platforms to trade on right now. There's institutional secondaries where people trading bigger companies, but I'm talking about like for smaller investors, smaller companies. And so it's just starting to happen. It's another path for investors, and it's another path to get, because it's all about liquidity. Like we have our money, like Benton, us, all of us, at least for me, most of my money is just tied up in investments, okay? Meaning it's sitting there I don't know when it's ever going to come out. As I say to my wife, I say, expect nothing out of this. This is money put in, and we need to find another way to enjoy our lifestyle because it's not going to happen from this. Now, that's a really kind of negative view, and I know that some of them will. History shows that they will. Might be my grandchildren, but history shows it will. And so my point is, there are other ways to do it, John. There are other ways to get liquidity that, but most people aren't thinking that way. They're thinking, through the traditional cycle. And private equity, you see the numbers. It's not happening. Private equity right now is in bad shape. If you've seen that, you could just see the recent analysis from from Pitch.
Right.
Go ahead, Ben.
So I let the record reflect that Bobby says he does not need any of his investment money back. He's not expecting it. Maybe his grandchildren. That's not why we do it. It's all about the joy with Bobby. The more complicated the deal and the higher the risk, the better, right? And the longer the return.
Which means I'm insane. Which means I'm insane. Thank you,
Yeah,
Ben.
well, you have to be a little. You have to be a little in the best way. And the question was, do you ever think about skipping venture capital, right, or eliminating venture capital?
Yeah,
And my
investing in
answer,
those companies that are not on the VC pathway, right? There's 0.01% of companies are on the VC pathway. There's another 40% that probably are able to capture a sub-market if they took outside money at the right time.
yeah, I've always thought about it. And with my startup, we raised fairly large angel round, which is the the foundation of this model. We skipped venture capital. I did a lot of debt financing and receivables financing, and we were acquired by private equity. So literally skipped venture capital altogether because I didn't want to give up that equity. I was comfortable with the risk of debt, and we were building a cash cow. So the company was throwing off cash. So I didn't have to play by the venture capital rules. That's not for every industry or for every company, but I'm always thinking about that. And I love that Bobby is literally in the trenches of alternative finance daily. And so is Looney in Africa and in the US. And there are different ways. We've experimented with financing receivables. The interest rates haven't been very cooperative for that build out, but we've been declaring venture capital if not dead, severely damaged for the last 6 years, it seems like. Angel stepped in and rescued venture capital in the pandemic, or else no deals would have been done. None. In 2020, they would have just sat on their funds, and we funded some great companies, and we're seeing those companies mature now. I don't know that venture capital is going to be the answer for very few companies we see. And like you said, John, it's a fraction of a percent, and that's not even accounting for AI. So AI is the opportunity cost monster in the room, and it is the obsession for some legitimate reasons, but the obsession with VC and private equity for a while, and it's not going to change. 95% of every dollar in VC, Series A and beyond, is going into direct AI. And that means you have a very small pie to fight over, slice of pie in the VC if you're not in AI. Now, if you are in AI, happy days, you can build $100 million company in about 24 hours with two people, maybe 1.5, with the 0.5 being a model. And that's cool. We're seeing some really exciting changes. And I'm don't get me wrong, I'm excited about AI, and it should take all of the dangerous, dirty jobs from humans so that we can do more fun stuff that gives us joy instead of digging ditches and blowing up caves. But that's the reality we're in. So if we take VC and just understand that it's almost an impossible game if you're not an AI company and discount it, then what do we do early on to build a company that can get from our investment? And maybe it's not just one investment, maybe it's a tranche of investments that align with milestones. like Bobby was talking about. Maybe it's not, nebulous traction. It's 10 customers that bring in X amount of revenue in this geographic region. And then when that happens, we'll invest 2 or 3X of what we invested already. And we already have a playbook. So the founder's comfortable. We can show that we can add value by bringing customers in or bringing in key hires. And that platform allows us to have more equity than we would have if a VC had stepped in and diluted us by a half. The founder then gets to keep more equity, and we work together to grow for those first 2, 3 years, or 14, as David said, of those years that are so difficult. And then, there's no easy year in a startup. That's just a reality, right? For anyone who's been there, you have to be obsessed with solving unpredictable problems daily. And that's the most rewarding but most challenging job there is. So that's something I'm thinking about a lot. Bobby and I have been talking about doing renewables and factoring receivables for a long time, but the interest rate just doesn't really align right now. But I think those milestone payments and a bigger first check from a larger angel group, and like, look, we're an angel group, so we're writing 7-figure checks quite often now. So it is very much seed stage venture, and I think that's one of the most likely outcomes of what we see in the market. Keep in mind, venture capitalists, they're not writing checks with their own money. They are running a fund. So people have given them money. They have to spend money, whether it's good or bad, or else they lose their job. Angels, or whatever we're called, very different if we're writing our own checks. If it's a family office or an angel venture group or an angel conference, we're all pooling our money, and we can choose. We're not going to get fired from our family if we don't make an angel investment. In fact, it's probably the reverse, the inverse there. So the fewer checks you write, the better your marriage is. But yeah, that's where we are. Bobby, what do you think about?
Yeah, just quick thing I'm going to say. For the founders, the first thing I always say to founders is, if you don't need to raise capital, don't. Okay, meaning if you can scale your business, you have unit economics that you can grow, especially in the early stages. Do it. Okay, don't borrow money. Don't do anything. Now, in most cases, that doesn't exist. The second thing is the ecosystem that you participate in makes a hell of a lot of difference. So, for example, whether you're in Seattle or San Diego, we all have different ecosystems, or Northern California, different ecosystem. And it really does, you've got to evaluate where you should be based on what you're doing. And I'm just going to tell you like a 30-second story. I was up with YC. It just happened to be my nephew, who family was from Germany, just went through the YC cohort. Never had a startup company before, 3 German founders. They go up there, and in 6 weeks, they have 4 customers. They raised $3 million on a $30 million valuation. Now, if you brought that to San Diego, I suspect Seattle, they'd say, well, yeah, David, exactly. The hands went flying in the air, right? You'd say, have a nice day, go play somewhere else. And so I spent time with them explaining to them, great if you get the money, but I want to tell you, if you go outside the ecosystem, things don't go so well. You're going to be having different conversations. But these are 23 to 27-year-olds. They're living the dream of their lives, by the way, back to the joy factor. Anyone at their age would say, my God, I just went through YC. I got all these customers. I talked to 60 investors in 1 week. I mean, so the reason I point that out to the founders on this is that choose your ecosystems. I'm not saying that's right for anybody in this room, okay? I've recently been sending some people who are going to be in Skydeck, Berkeley Skydeck, okay? Because they're right aligned first. And San Diego Angel Conference or Seattle Angel Conference or whoever it is, think it through, because you only have so many hours of the day.
Yep,
and
absolutely.
So anyway, that's it.
So I'm going to give Kevin a chance to say hi here as a transition. Kevin, say hi. Let everybody know what you do as an SBDC thing.
Hey, Kevin.
Hi, thanks, John. So I'm the SBDC, part of the Washington SBDC, and We're a service broad general advisory, and we can help you noodle through things. Really good at helping people through inflection points, and look forward to supporting any small businesses in Washington State. That's what they pay us to do. Happy to help.
Except that you are one of the very few SBDC people in the state of Washington that knows what an angel check is. And so you
True.
are probably the one that this audience needs to talk to rather than the random person at the score office. And so let me make sure that people know that you know what an angel check is. So given that, thank you very much, Kevin, for letting me do that. Um, I want to make sure that everybody has a chance to ask that last question because we're sort of running out of time a little bit. Our deadline for the Seattle Angel Conference for companies to apply is the 18th. We're also have a few investor slots available for people who are wanting to come in with that. Um, but if you have questions that you want to ask about the startup journey or the funding journey or how we think about things, now's a good time. Just raise your hand and we'll call on you. David, you can kick off with something. You have never had a conversation with these guys, and they're a great group of people.
The thing that's top of my mind right now is figuring out how to run the SPV that we're going to make for SAC 30. We
Yeah.
haven't picked a company yet, so we haven't made that SPV. And
Well,
there's a number of service providers, but apparently we can also just run it ourselves.
so just
How
to give them a
complicated is that?
chance to think about this, um, part of what we do when we have the lead investor role that David is doing, we ask them to set up the SPV and we ask them to sort of research that across the possibilities. You know, I could use sidecar, I could use allocation, I used to be able to use Carta. I could go to a lawyer and have them craft something for me directly. Just what should I do to set up an SPV to make it go? We're primarily utilizing sidecar at the moment. There are various reasons why that's not always the best feeling. So, how do you guys think about SPVs? I know Bobby is a get on the cap table kind of guy, but sometimes SPVs are useful.
Well, I'll give you I've done I've done my own SPVs. I've led them. Um, they're fine as an instrument to help. They're simple to manage. But you got to be committed for the duration of it. Someone's got to be committed. So there's sort of the administration of it and the management of it. Usually some sort of quasi-legal or a platform will manage the technical part of it and the communication. But it's still when somebody has a problem, the 27 people on the on it call me. Okay.
Right.
And I think, but I think and you got to realize the costs associated. You got to make sure there's enough money in it to file, whatever state it's in or whatever location. In California, you got to pay money each year, for it. And uh, and usually the unit economics usually start at like the low hundreds of thousand. I say about 120, 150,000 to make sense for it. From a founder perspective, it's an easy mechanism to use. I mean, it's not, but you want somebody to lead it. You need an investor to lead it. That's my opinion. I don't know if Benton has a different opinion
David, I
about it.
have to step away for a sec. Can you manage the questions for a bit?
Yeah, I got you.
He's got you, John. Yeah, it's a question of scale. You can't have 20 people put $100 in and call it an SPV that's gonna work, especially in California where you have to pay $800 a year just to exist. But there are clever ways. I mean, Carta was a big loss. Carta had a good, easy system. I love SPVs for the right company. That has to be like the ten diligence risks. You have to get through all 10 of those, and then number 11, it goes to 11, is okay, now it's in an SPV. Then you have to analyze that. What's the carry? What's the cost? What's the time? Who's running it? Are they going to check back? And keep in mind, like, the angel conferences are an SPV essentially. It's an
They
LLC
are.
set up, and there's trust and communication, and you're a name on a cap table. It's an LLC, shared interest, but it really is an SPV by any end of the name. So for me, like what I get excited about an SPV is usually when it's a great deal. Clearly, there's a huge lead investor, and we get, they're trying to close out the round, and there's 10% left. And I can't personally, subscribe for that 10%, but our group can. And, we can all throw in 5, 10, $20,000, sometimes 50 or 100, depending on who you are. And then you can get into that deal that Bobby's talking about. That's 30 million, that Y Combinator is going to push to 100 million real quickly. So some of those times make sense, but SPVs, just keep in mind, some of the professional SPVs that have multiple layers, like
Oh,
if you
Why
go
is Bobby shaking his head no?
no, yeah, that's awful. Yeah,
yeah, so I mean some of the secondaries for big AI tech companies that are out there, will have an SPV, and then it will be stacked into another SPV, and there's multiple, just like any investment, there might be multiple management charges, and you're not really sure what your equity is worth. So I'd be
I mean, that
wary of
almost,
those. The ones that are spun up by, locals, for companies that we see make perfect sense. And, a
yeah,
big part of early stage investing is diversification. So if you don't have 10 years to build your portfolio one company at a time, that's a great way to make a lower ante into some funds or some companies that we wouldn't normally be able to invest in because of the
and
size.
and and, and the other thing is, we found, like, in our community, there's some people who like to do it. I mean, they just get really good at it, and they're doing it over and over again for these deals. So the mechanisms are, highly automated, easy to do. There's lots of trust. And they don't, some of them won't even carry, there's no real carry in a sense. What I mean by that is, like, if the deal happens, they get their money, their investment out of it. We get our investment, whatever the upside is, we all participate. And then there's some small amount of just fees just to pay for the, a hold on money so that they can pay for the fees. So let me just say one thing. I've had people underestimate SPVs, and then I actually do have you have a cash call. I have one that I've been doing for the last couple of years, and it's small. It's like, it's like $100 or something. It's nothing, but $100 over 20 years, you got to decide, do you want to keep doing it? Those are the kind of things
oh,
that can happen.
sorry, what does that mean? Like they underestimate? Because like,
We
so
put
The
when we
we
look
put
fees, they
at,
in
underestimate the fees. They underestimate the fees that they have to pay to the state, like filings, like Benton was talking about, $800, or an accountant to take care of the filing, or administrative costs, whatever it is. They
okay,
underestimated, or they thought it was going to be 7 years, and now you're on year 10 already. You know?
And we
yeah,
see that a
that's
lot
like
right
what
now.
Yeah,
we look at with sidecars. Sidecar says if you want to do the deal that's 250K, they'll set up the whole thing for you, and the all-in price looks like $7,000 plus any state's blue sky fees, which, as I understand, are only one time. But then that also says you have a cap of 10 years that they're going to handle it.
right. So you better find out what happens after 10 years. That's always what I say, even on our funds. I always say to people now, what happens after 10 years? Because that's the world we really live in right now.
Right. I mean, and
So SAC 5 exited 14 years later, right? So somebody had to pay the fees for years 10 through 14.
Right. It doesn't make any sense. These 10-year things don't make any sense, but in the land of reality, they don't make sense.
Yeah, so I want to make sure that our audience can ask questions. Anyone have a question they want to put forward to these smart people? No. Jared, surely you have a question, Jared.
How about to these not so smart people?
Go ahead, Jared.
So, as a early stage startup, I've been funding, bootstrapping it myself. We've gotten to the point where we have some traction. We've got 5 companies on our platform. We're doing our best with what we have, and when discussing like a safe or discussing like our first rounds of funding, we have to put our finger at some point maybe on a valuation. Like, where do we get that number? How do we distill down to something that is even in a ballpark? Because I know numbers don't matter. So then I can throw something out there and just have it stick. I want to make sure the rest of my numbers correlate to something meaningful. How would you guys go about like anchoring that?
Good question, Jared. We hear this a lot. So you said you have 5 companies on your platform?
Correct.
So those are customers,
Paying customers. Yeah.
paying customers.
We've got yeah, a lot of unpaid, but I only count the paid right now.
Why do they love you?
They love us because we've been making their day-to-day lives easier, like their operations easier, and saving them a lot of time. That's what we hear.
And that time is money, right?
Correct.
So at this stage, you have customers who are willing to pay for what you're building. So you have revenues, and there are some traditional ways of calculating a valuation. They may not benefit you very well because your revenues are probably still pretty small. The best way to do it is to look at the market and figure out maybe you want to be 3, 5 years down the road of your revenues is where you want to be valued. Investors, however, will they're willing to write checks for companies that are 2 million, 4 million, $10 million valuations. And you can go to PitchBook, you can go to Crunchbase, and you can see free reports based on industry where you might fit in there. And then the art form kicks in. Then it becomes telling your story. It's like, here's where we are right now. Great. Your company's worth, I don't know, $100,000, $500,000, 5 million. I don't know. I'd have to dive in there with you and find out. But you have the opportunity to kind of set a guidepost. Now, the investor, if they're really interested in what you're building and they love you and we want to continue this conversation for the next decade, they're going to tell you what they think of the valuation, unless you've already got a lead investor and it's set in stone. So it's good to have an idea of the range, right? Obviously, you want the top of the range, investor wants the bottom of the range, but that's a reasonable discussion, right? It's not, I have $100 million company, I have no plan, just give me $10 million and we'll build it, right? That's what I hear a lot. It's still, a lot of people thought Silicon Valley was a documentary and not a comedy, but that happens a lot. So get as much information as you can that's out there. Talk to people like John, people at the SBDC, and find out what the market is, because there are seed stage companies raising at 1 million and 100 million, and that's a big range to just guess at. But we can guide you depending on the industry you're in and what your prospects look like for growth. And that's what comes back to traction. Like, investors are going to give you some credit for being able to build. We want to get in early. We know it's small. You're not a great investment right now, but you will be, because you're going to work hard and you're going to grow the company to X in revenues and X% a month. And you have a plan, and we believe in that. So you have to figure out what the company is going to look like in 3 to 5 years and kind of reverse engineer it to today's pricing. And you want to make sure that you're not offensively high, but you also don't want to leave money on the table, right? So gather info. There's a lot of free intel out there, and there's really talented people just on this screen here that can help you with that sort of thing. Bobby sees a lot of this early days, and I know he has insight.
Yeah. Well, the other thing I would say is also add to your list looking at Kingscrad. Kingscrad analyzes a lot of the platform companies that raise capital. They publish the data. So add that to your list when you analyze it. The second part I was going to say is it depends on whether you believe that your business, and most importantly, is whether the investors believe whether you're a scalable business and or whether you're going to be a lifestyle business. And that makes a difference in even the model of how people invest. So for an example, if somebody sees you'll be a $10 million business and you'll be running it for the next 20 years, okay? the model says that somebody investing is going to want a big chunk of your business, typically. In other words, they'll give you money. I don't know how much money are you trying to raise now? Just as an example. Do you have a number already?
750,000.
Okay. So 750,000. So they're going to think to themselves, what is that $750,000 one going to do for you? Okay. And how are they going to get a return on their capital at some point in the future? And it's that simple. So how do you make that case? All right. If you're going to be a $10 million business or a $5 million business, that's a different model. That somebody says, all right, I need to get a return on my investment and I need to figure that out. But if you're going to be $100 million business, then we'll use the word scalable in that conversation. I'm just giving you arbitrary numbers. The other thing is early stage investors have their own biases, meaning if you said you were a $20 million valuation, if they were marginally interested, they're not even going to talk to you anymore. They're just going to say, have a nice day. Okay. If they're particularly interested, they might get in deep. They might say, you're wrong. This is crazy. You got to rationalize it. And if maybe you have something to rationalize, I'm not going to say you're not going to, but it would be rare. It would be a rarity. So, and then you have to think strategically long term. What's going to be the next capital raise? Are you going to need another capital raise? Because if you're raising at 750,000 and you're at $15 million, we're going to think differently about you than if you're at $750,000 and you're 5 million. And that's just a multiple. Like it's a simple math. It doesn't take, and it's a bias. I'm not saying it's even right always, but it's just a bias that somebody does in their head. Okay, my God, they're at this number. I think they're going to be $20 million in business. Like, let's move on. I got 5 other guys deals that are because realize our group, just as an example, New Fund, and I'm not saying you're right or wrong for New Fund, they have like 300 deals in the pipeline, like sitting there that are at top of funnel, middle of funnel, and getting ready to vote, for investment. And that's the way everybody's operating. So you just have to make sure you're aligned with the right people when you're talking to them too.
So one of the things that happens with the Seattle Angel Conference is when you are at a normal angel group, you go to the screening committee essentially alone. You get one-to-one conversation with a couple people. You go to the pitch essentially alone. Maybe you have a couple other companies, but not a lot. And all of the other companies have been screened out already. While in the in the Seattle Angel Conference process and the San Diego process, the 60 companies all get to see each other. So now you have perspective on all the people that are at your stage looking for money. And you typically, as a founder, don't have that perspective about what everybody else is doing. And so the investors are seeing, again, 1,000 companies, of which they're taking the ones that have warts of one kind or another and shuffling them down to other people or to other places or being polite and doing nothing, but they're not getting into the 10 that are getting deep due diligence. And the ones that are getting deep due diligence still typically don't see each other, except in our program, they get a little bit more feedback, right? So having perspective on the market is really important for you.
Yeah.
And when you have that perspective, it will tell you where in the market you should be looking for money. Because if you're not an AI company, there's a whole bunch of money that's over on the other side, right? If you are a regular startup with a regular thing and there's a trend that you're following, there's probably a set of investors that are following that trend too. And you would like to discover where they hang out, right? And you can find that by looking at where companies like you are showing up. Yeah. All right. Are there other thoughts in there that people want to deal with? So I have a question. I think, 10% of your net worth is the most you should invest as a personal angel investor. I know somebody who invested 50% of his money in that, and which caused a bit of a row with his spouse. But most part, 10%, and then as a max. And then you need to be in 20 to 40 deals. You guys both seem to have blown way past that number. But that to me sets a check size. And so you have a check size that you can write with stability. And then my expectation is that I'm hunting for the best deal this quarter to make an investment each quarter so that I have a steady pace of writing checks, because the number of things that are interesting far exceeds the amount of money I have to spend. And if I wait for the most interesting thing, I'm basically waiting forever, right? Because there's always something more interesting next meeting. And so, how do you think about how you should structure as an investor investing across the 40 to 60 companies? Or maybe the opposite way to ask that question is, how did you get the portfolio you've got now? And what level of intentionality of portfolio building did you have?
Yeah, I would say when I started, I became an addict and I just invested like crazy. Somebody said to me,
Too big a check, too fast with not enough due diligence.
well, no, my check, the one thing I will say is no, I didn't generally write too big a check, but I wrote lots of checks. And because I listened to a bunch of people that I thought were a lot smarter than me, okay, or knew more than I knew. And I realized that, if I didn't invest in 30 or 40 companies, there was little hope of me seeing any return on my capital, or very little return. I'm not saying that was rational. I'm just saying I immediately started doing it. And so in the first year, I invested in whatever it was, 40 companies or something. I joined a
Damn.
fund almost as quickly as I could within a couple of months, another fund. I was with STAC originally. That's how I started, with STAC. And then I got into new fund, and then I started investing. So I don't have, like, I don't wake up each year like now. I don't wake up in each year feeling compelled to. I can invest in zero this year. I didn't. I invested in a couple of companies, and now I'm at the stage where I have relationships with some companies. So I'm generally looking at who's doing well and they need another round and it looks interesting, and I'll invest in it. And then maybe one or two deals that come along, and the fund does what they do in terms of the fund. And
And
I
so,
participate sometimes a lot and sometimes a little. So
so
in my
you,
investment range, I'll just say one last thing, Joe. My investment range has been between 2,500 and 30,000. That's my investment range in
right.
terms of the angel investments. Typical is like a $10,000 investment. It's just very typical. And the ones I invest directly are the ones I've built relationships with that I was really highly engaged and interested in. And then a
Yep.
few early on, they just built relations to me, and I was an idiot. I just didn't, honestly. I invested in companies that I shouldn't have, in retrospect. But I was emotionally tied to them, and I made bad mistakes. So there's probably at least a half a dozen of those that have proven to be foolish investments.
And so you are what I would classify as a mature investor. You're doubling down on the ones you know. You're writing fewer and fewer checks. They're more measured in your activity, where at the beginning you were writing a lot. And that's an arc for angels, right? There's a point where you're not an angel, you become an angel, you have a habit of writing checks, and then there's a point at which you stop writing checks, presumably, because it starts looking like all of the returns are going to go to your grandchildren. And you
Well,
and
and I'm okay. Yeah, I'm okay with that. But I don't. The other thing is, I don't have unlimited capital. You know, I mean,
right.
some people may have. Nobody has unlimited capital. But my point is, I have limits in my capital. So you balance lifestyle, other investments. Child going to college, whatever it is. With what you're doing. So, like, there is no one. Let me just say this: there's not one type of, when for founders. There isn't one type of angel investor. There's guys who are only going to invest like $20,000, and there's guys who are going to invest $2 million. There is not one, but you need to, part of your process is to identify those people who align again with you at the moment that you need capital.
Yep. So I'm going to take Timu's question as the last question and call it the day. Timu, you want to ask the question out loud?
Yeah, sure. Thanks, John. Appreciate it. So I'm kind of curious on how much groupthink. I heard earlier on in session, there's like, hey, we know each other. We go, surfing. We do all this shit, which is good. I mean, that's a good point of, evaluating certain things. But at the same time, it also creates groupthink. I'm very familiar with groupthink, having been in some big companies. Inertia starts happening. And sometimes it's a good thing because behind a good idea, sometimes it's also, well, I just trust them because, they've done the research, and really they didn't. It's really something that came along from another source, and that source actually wasn't that good, and so forth. So it kind of got diluted, the validity of the groupthink started from a bad source and but got amplified through the friends, and now all of a sudden everybody's like ganging on to a bad idea, or just trends in general that are like, hey, back in the day we were talking about AI. Well, AI, I mean, in my world nowadays, it's just a tool. I post it somewhere else. Use it wisely. Don't abdicate, ownership to it. That's the huge fallacy a lot of people are doing. They're literally saying, let it do everything. It's like, no, no, it's a tool. Become a master of the tool. Don't let it become the other way around. So how much of this groupthink is part of your process or affects you, I should say, and not part of your process? I don't think anybody intentionally does it, but just kind of trying to get the.
Well, I think the answer is there's groupthink, of course. There's groupthink. I mean, I can give an examples of where, hopefully you got smart people who group thinking, but where it's, you got a group of people doing due diligence. They vote on it, whether it's SDAC or whether it's new fund that we're with. And then you trust those people to make diligent decisions, which sometimes it's not, and sometimes it's bad. Sometimes the direction's bad. And then, you participate or don't. Benton, go ahead.
Yeah, no, you're right, Timu. It's a concern to worry about groupthink whenever you have a big group of people that they may all share one brain. At a fund that has the right culture, that challenges each other, it becomes pooled intelligence. And I think that's how the two funds here in San Diego work. Um, a lot of that comes back to Misty and John when they set up the San Diego Angel Conference, just like the Seattle Angel Conference. Amazing inflow of experts in their fields got together. And I learned about biotech and life sciences, even though that's not my specialty. Realtors learned about clean tech and sustainability from me. We came together, and yes, we had influence over each other, but at the end of the day, we knew who the experts were in each area. So, like Bobby, if I had a marketing company that was early stage and we were talking about building out a marketing campaign and looking at the dollars, he would have very granular info on that. I don't know that, but he does. Yes, we might eventually agree on that's a company we want to support, but we build teams, outsource a lot of the diligence to those teams, and then we come together. And over time, you learn to respect each other and your subject matter expertise as it leads to good results. So it does take time. I mean, um, when everyone comes together in the first meeting for an angel conference, you think like, oh, okay, we're going to throw our money in here together and we're going to invest together. And you spend a couple of months getting to know each other, and everyone's very supportive. It's very positive. No one has anything negative to say. But then when it comes down to writing the checks, things change, right, John? Like then
Yes,
it's
they
like,
do.
then everyone starts campaigning for their company, the one I was on the
Right.
diligence committee, the one I wrote the memo for. That's where the problem comes in, because you can have stacks of those conferences and funds that write diligence memos. And as you alluded, you may not know the person who wrote that diligence memo for a different angel group on the East Coast or in Texas. But you might rely on it, and then you might rely on your co-investor in the fund that reads that and just copies it verbatim and says, "This is it." So we at New Fund, so New Fund is 300 plus members now. It's the largest angel group in the country. And it's not even called an angel group, it's called a venture group because we try to do things a little differently. But I'd say probably 60 or so of the members have come through San Diego Angel Conference. It's our farm club, and that's by design, little bit in the rear view, but by design, that's how we do it. So that culture that we built at San Diego Angel Conference of being curious, but questioning each other and really not jumping at the very first recommendation, but peeling it back and understanding it has grown into this bigger venture group. And at New Fund, we have created with AI and some universities a very slick way of bringing it. Like we have how many, Bobby? 10,000 a month inflow. So we have
Yeah.
AI filters, and like back to how many deals do you do? Innovation doesn't follow the calendar. It's not like I can do one deal a month and expect to have the best investment. Sometimes you have 20 in a month and you've got to move fast. Sometimes you'll have a dire month and only one or two. But we have an AI filter that immediately takes the deal in. If it ticks the boxes on deal size and the things we're looking for, it will immediately go to the subject matter experts in the fund. So instead of all of us getting together, hundreds of people waiting 3, 4 weeks for a great company that's about to close a round next week, we bring that in, we scrub it, we send it out. We have 2 or 3 people who are subject matter experts. Like I'll get a ping that says, okay, this battery technology is a Y Combinator spin out and is raising with breakthrough ventures. And do we want to take a look at it quickly? And we'll be able to do things like that. And that completely avoids all of the groupthink, all of the people who don't know anything about the technology. And that allows us to then get timely investments into the best companies. So the more members we have with the more subject matter expertise, the better it gets. But then you do have to make sure that you don't have the same 10 people always on the deal committee saying these are the deals we like, because you will get, whether you have an investment thesis or not at the fund level, you will get a certain amount of deals that all look alike. So
Yep.
it's a daily struggle, but you can use technology to help design around it.
Tina, one
So
last thing
the
is the Brink has 15, roughly, we have 15 advisors at the Brink. So, and many of us are engaged in whether it's the Angel Conference or New Fund. So, we see, I myself handle 50, 60 clients a year. So you got 15 people, we all spend different number of hours with the Brink. So we do have outside perspective. It's not like, we're having intimate conversations. Now, not all of them go to New Fund. Very few of them go to New Fund. But that does give us visibility into the market. And those are only San Diego. By the way, the Brink only handles San Diego companies, period.
Yeah. So the design of the Angel Conference was specifically designed to spin up things like New Fund, or in the Seattle context, Seattle Angel Fund that became Venturous. And so the groups learning how to play nice together is part of the conversation. And part of that is learning how to take the strong voices down a notch and take the soft voices up a notch. And so that facilitation process is a skill that people need to take with them as they create those funds. So we've succeeded in both Corvallis, Seattle, and in San Diego to get this follow-on thing to happen with investors playing nice in a group to do those things. And I'm going to call that the end of the conversation. Clearly, we would like to have some more conversations. This recording will get posted to our YouTube channel, so feel free to become a subscriber of the YouTube channel. We'll continue down this theme of looking at different pieces. And if you have regular questions like this, David and I run an open coffee every week virtually where we dive into these conversations. So please feel free to join us. Thanks very much for everyone for coming. Bye-bye.
Thanks. Cheers.
Bye bye, guys.
Thank you, guys.
Welcome.